Hey, everybody, and welcome back. Michael Wagner, Matthew Adler, you're joining us for the second part of our conversation around real estate, asset prices, coronavirus. The list goes on. But welcome back. Thank you for being with us, Matt.
It's good to still be here
Yeah.
and continue the conversation.
Absolutely. So, we were getting into a good flow, and you know what? Let's get back into it. So, what is the biggest challenge you face as a real estate investor today?
Well, in the first part, I talked a lot about how strong the operating metrics are for real estate and the difference between sort of the operating metrics and the acquisition, the investment metrics. And there's definitely two sides of the coin today. For what I do in light industrial, there's incredible demand and very low supply of space and really great operating metrics. The flip side of that coin, though, is it's tough to buy. There's definitely some more competition. We feel very good that we have a lot of experience and great relationships and strong reputation and a lot of barriers to entry to our space, and it's a niche, and it's a mid-market transaction size, and we feel very good about our ability to deploy capital, and we have a great pipeline today. Frankly, there's with so little transaction volume in 2020, there's a lot of deal flow right now, and we've been bidding on more properties in the last 60 days than I can ever remember. We actually have one under contract right now. We're hopefully getting close on a second. But it is it's always hard to deploy capital, right. And it's even harder today to make acquisitions.
So you work with a lot of groups that are responsible for allocating capital. What do you think the biggest challenge they're facing today is?
Yeah, it's actually interesting. It's a related issue, and it's something that has evolved, and I'm seeing an evolution that's taking place right now. And it's one of the places that sort of, I always joke that investors are not necessarily aligned with themselves. We're always trying to create alignment of interest between us as the manager and our investors, but there's one specific area where investors are not necessarily aligned with themselves, and that's in duration. And we're an illiquid strategy. When people invest with us, they're making a long-term commitment to real estate. And most investors, especially when they start out with us, want to know how long their money is going to be out, when they're going to definitively get that money back. The problem is, and now what we're seeing with investors that have been in our investments for a long time is you sort of get to that point. Now, investors don't want us to sell. They don't want to have to reinvest. They don't want to have to reallocate that capital. They like the distributions, the dividends they've been getting, and they certainly don't want to pay taxes. And we have real estate in particular is a very tax advantaged strategy. A lot of the taxes are deferred, and they're realized once you make a sale. So I think sort of investors and allocators of capital are sort of coming around to that, and they're recognizing that longer term strategies are better, and they're getting less concerned about liquidity, more comfortable about having long term illiquidity, and I'm seeing a greater trend towards longer term holds, longer term real estate investments, and I think that's a good thing for investors. And listen, we all see lots of examples in the world of long term real estate investment creating a lot of wealth. And at the same time, when many investors go into a new deal, they want to know that they're going to get their money out quickly. And that's not necessarily, again, the right alignment of interest. Probably buying good real estate and holding it for the long term is a better strategy.
Sure. So it sounds like to me you're seeing more and more comfort with illiquidity. People are recognizing that you can generate additional return by being less liquid than, other instruments.
And there's a trade-off for liquidity. I mean, you could accomplish daily liquidity and buy a real estate REIT. Okay, right. The reality though is that does not perform the same way as a private real estate investment will. Private real estate investment will provide probably greater cash on cash, greater annual dividend, greater IRR, and better tax benefits, but has illiquidity. In general, I think liquidity. Although everyone should have liquidity, I'm not suggesting people should not have, like in a well-diversified portfolio that you're going to help create for them. Everyone's going to have, probably the majority of their assets in liquid investments. But I think there is a benefit to investing in certain illiquid assets, whether that be real estate or private equity or other assets. And there's the trade-off. And generally, while illiquid assets or liquid assets could provide great returns, and they provide that optionality for either daily or weekly or monthly liquidity, whatever it is. Illiquid assets provide a very healthy piece to someone's portfolio that I think people are getting more and more comfortable with.
I agree. I think there is growing comfort with the role and the purpose of illiquidity in your portfolio and being mindful about that liquidity allocation and knowing why you're doing that.
Especially in a low rate environment. I mean, we're in a very low interest rate environment and very difficult to get, consistently attractive returns in liquid assets.
Sure. So I want to transition to something that's on a lot of people's minds, and it may not be exactly in your wheelhouse, but it is real estate. Residential real estate specifically, the housing market. What's going on? Please enlighten me and us. I'd love to hear your thoughts.
Well, in the first session we talked about asset inflation, and certainly there's probably been no other place that has had more obvious and recognizable to everyone, and everyone is sort of participating in the asset inflation in real estate, in residential real estate, whether they're a homeowner or an aspiring homeowner, right. Someone that wishes they were a homeowner. So, obviously that issue can be somewhat different depending on where you are. We're in South Florida. I assume the majority of your clients are in South Florida. We're very fortunate. We live in a desirable place to be, a place that forever. We were, a few minutes ago before we started recording, talking about when our families moved here. I think some of the people who, are the newer residents to South Florida that are part of the trend that is a very significant wave that has happened in the last few years of people moving to South Florida think that it's maybe a new thing.
Right.
My family moved here in the 1950s and also came from New York. So, but the trend that has occurred more recently that was certainly accelerated by the pandemic is a particularly notable trend, and it's a particularly affluent trend. I mean, the people who are moving here are more affluent than probably have been historically moving. And it's for obvious and great reasons. I mean, we have great weather here, and that's always been something that's attracted people, at least since the advent of air conditioning in the 1950s. We have a very high quality of life. We have a very tax-friendly state. We have a very business-friendly state. And what you're seeing is people who are on the fence about moving or considering about moving. Sort of the pandemic was the straw that broke the camel's back, and they're moving here. And obviously, things like the SALT tax issue was even preceded the pandemic.
Right.
So we're seeing a very significant migration of people to South Florida, particularly in the high end. And I think while that may plateau to a degree, I'm not suggesting that we're going to see the degree of mobility that we've seen over the last few years. I don't see the residential real estate market in South Florida where we have limited supply, we have barriers to entry in terms of, we're a supply-constrained market with the Everglades in the west and the ocean on the east, and there's desirable places to be. I think if you're an aspiring homeowner, you should not be afraid to enter the market. I think if you're a current homeowner, you should be happy that you're in the market. And a real estate holder, and most importantly is if you are in residential, is make sure you have the right house. And if you're gonna, if you're looking to buy a home, buying a home is not, as we talked about in the first session. Residential real estate is a qualitative decision, an emotional decision, not necessarily like commercial real estate. What I do, a quantitative decision. Find the right house. Make sure if you buy the right house and you're in it long enough, even if there's a momentary dip in its value, it'll roar back. And even people in South Florida who bought in 2007 in advance of the global financial crisis, which I would be very surprised to see something that significant impacting housing in this community. A number of years later, we're certainly the value of their home has grown above its that dip or that original value.
But so that's an interesting point, right? So where do you draw the line? Like, so if somebody's sitting in a house and they're looking at it and let's say comparing it to stock market performance or kind of looking at their home as an investment, where do you draw the line between like a use asset, personal use, your shelter, and investment? And how can you help people tell the difference between this is a use asset or this is an investment, and how can we better recognize these scenarios.
Yeah, listen, we all need a place to live, okay? And most of us, although maybe some younger people don't need a car, but
Right.
we all need a car. Most people don't really differentiate between the car they lease and the car they own. I own one, I lease one. I think they're both my car. I don't really think about the fact that
Right.
one is leased and one is an own. It was just the financing vehicle at the moment. And so I'm not anti-renting a home by any means, but if you decide you want to become a homeowner, recognize that your home, although it has, for many people is a very significant investment, and for many probably their largest investment, it's not a real estate investment.
Mm-hmm.
A real estate investment is an investment in income producing property that is ultimately going to provide you either current cash yield or going to provide you a strategy, to provide a strong internal rate of return at the end of its investment. Don't confuse your home ownership with the piece of your portfolio that should ultimately be a real estate investment. And I think, further on that, I think one of the things that we're seeing today, because we talked about how difficult it is to allocate capital,
Mm-hmm.
it is particularly difficult to allocate capital if you are making that actual real estate investment. I'm not talking about that home purchase or even that second home purchase, or all of that is a qualitative decision. If you want to own a second home, buy a second home because that's what you want to use it as.
Mm-hmm.
If you don't confuse your second home purchase with a real estate investment. Even if you are renting out, you're buying it because that's what you want to have as your second home. If you are actually making that real estate investment,
Mm-hmm.
though, it's very difficult today to make a real estate investment as a passive investor. It's been always hard to make real estate investments, but that 1031 property, that triple net property, the thing that you're just going to sit back and put it on the shelf and think it's going to provide you a great real estate investment, very difficult in today's environment where asset prices are today. If you're going to be a real estate investor, you need to be a real estate investor that or investing with managers
Right.
that is adding value, and you add value either with a development strategy, you add the value because you're buying something that's broken and it needs to be fixed, or you're adding value because it's particularly management intensive. This is what we do. We buy properties that are particularly management intensive, and we operate the heck out of them.
Mm-hmm.
And if you with the right value add strategy, the ability to increase the value, to add value to that property, and probably working with the right manager, you could make good real estate investments today. Without that, thinking that you're just making passive real estate investments, whether that's in that vacation home
Right.
or in that triple net leased McDonald's down the street, very, very difficult.
I often find that those passive investments can be less passive than you think.
Well, that's a great point.
Right.
When you're if you're thinking about that passive investment, if you are considering buying that condo in the ski resort that you really want to use, but you're also going to be renting it out, recognizing that there's going to be management headaches to that.
Right.
You're going to, and an expense, you're going to have to hire a local manager, you're going to have to hire a local leasing team. But by the way, even when you do that, that leasing agent's going to call you and they're going to say, hey, you need to make a decision. We have somebody who wants to take this week at this price. And you're going to have to asset manage your own asset.
Right.
So recognize there is an expense to your own time, and that's definitely going to be an issue, and something you should consider as opposed to investing with actual. Most people. One of the issues with real estate is real estate's so tangible. Everybody thinks they can do real estate. Most people aren't going to think that they're going to be their own investor in fixed income, or their own investor in,
Right.
in
Right.
different equity strategies or currencies, okay, or a hedge fund. But in real estate, people think they can necessarily do it themselves. I would suggest with whatever your real estate allocation is, find good managers that you trust, that are good operators, that have a good value add strategy, create a diversified portfolio, and invest with those professional managers, just like you would with any other asset class.
Matt, I think you've answered my question. If I'm looking to get into real estate investing, what should I look out for? What should I be aware of? Where should I start? I'll allow you to put a finer point on that.
Yeah, because I kind of did answer the question already, which is, again, I think like every other investment, you want to have the right manager. I mean, a manager that is going to be fully transparent and have great reporting, a manager that has a good strategy, that has a good experience. I think it's, this goes back to something we talked about in the first session about our strategy. Yep. We have a very specific niche, and we have a very specific way that we add value as being very management intensive operators. I think that's really important. I think investing in sort of some big fund that is, has some sort of open mandate, and they're sort of try to be, an expert in all things, I think is very, very difficult. We have a very, very narrow focus. We have a very clear way that we add value. I would be looking, whether it is with us or with others, find the right manager that is going to have that clear strategy, that is going to have a clear path to adding value, that is an expert in their field, that has a lot of experience and a track record in what they do, and has really strong reporting. I would always encourage anybody who's considering a real estate investment, look at the reporting of the manager and ask for past reports. I find it's amazing actually how many real estate operators do not do a very good job with the reporting, and I think that's sort of indicative of how they run their business.
Sure. Matt, I want to thank you so much for taking the time with all of us. I know I learned a lot. I'm sure other people did as well. It's really important for us to provide credible, reliable information to people. It's why we call this little segment Consider the Source. And it's really been a pleasure. Thank you so much.
Well, this is fun, and hopefully we'll continue, and we'll have a part 3 someday.
Yeah, absolutely.
All right.
Anytime. So thank you for your time, everybody. As always, be well. Thank you.